Alright guys, in this video I'll show you exactly how to earn 8 to 10% per month regular income by using option. Basically this is a short strangle and I'll show you when to deploy this strategy. Let's take a look. So this is the main criteria. How to select stock and strike price to deploy a short strangle. First criteria, that is high probability of success, which is 70 to 90% winning probability. And the second criteria, IV rank or IV percentile. IVP means IV percentile or IVR, implied volatility rank, should be above 50. That is the criteria. And high liquidity stocks, and we are selecting 20 to 15 delta call and the 20 to 15 delta put, and expiry it should be 30 to 45 days. All right, not more than 45 days, not more than 30. All right, deploy this strategy in a range bound market. So we are looking for like sideways market, somewhere like that. So we never deploy when market is shoot out. All right, so in that case we are using different strategy, that is like just lizard or something. So later on we will discuss. And another criteria, avoid during earning release. So I'll show you exactly how we select the stock. All right, now let's see the criteria one by one. So I am using Opstra. I'm not promoting this one for your better understanding. I'm using this platform, and here you can see option column, and click on there, click on option dashboard. Have you seen it? Click on there, and now here you will see all stocks there, implied volatility, liquidity, earning, everything, it will available. So later on you click on here table. Have you seen it? Click on there. Okay, now you can see here we need high IV stocks. First click on there, so automatically they are showing high IV stocks. Later on click. I basically use high implied volatility. Some people are using IV rank, so I prefer implied volatility percentile. All right, click on there. Now I can see all implied volatility stocks are available right now. All right, now later on here click on liquidity. So we need liquidity stock, otherwise it's very difficult to buy back or sell it. All right, now here another criteria. So we have seen some green signal somewhere there. Have you seen this one, green signal? Just let me click on here. Okay, green signal means they are going to release earning this month. All right, that is why we are canceling these stocks. All right, we are avoiding when a company going to release their earning. When they are releasing earning, it may shoot up or it will pull back. It may jump our boundary. All right, so that is why you must avoid this one. So now you can see call India, there are no earnings. So let me show you one by one criteria. First criteria, let's see here. Let me show you first. High IV percentile, we need more than 7. That is a winning probability. So we need high IV or high IVP or R. All right, more than 50. High liquidity stock, we will select 15 to 20 delta, 45 expiration. All right, ranging market and earning release. All right, all criteria should be fulfilled when we are going to deploy this strategy. Now first we have seen call India. So let's see call India here. Let me click on call India. Sorry, call India. Okay, this one call India. Click on here, chart, daily chart. Now I can see call India this is a trending market. Now we have seen a little more range in between this area, so we are expecting that price may stay in between this range till expiry, right? Like that. Like this is the upper range and below range somewhere here. So we are expecting that price may stay in between this range. After rally, so it may take a rest. All right. So we are expecting that price may stay in between this range for 1 or 2 months. All right. Now let's deploy this strategy, and here click on another here, write down call India. Okay, click on here. Now click option chain. Now see, this is option chain current expiry. It's going to expire on 28 October, and we need 1 month, 30 days or 45 days in between this range. So now I'm selecting 25th November. All right. Now see the delta here. This one is strike price. Here you can see this one is strike price, and this is put delta and this call delta. So first we will select above 15 put or below 20. So now I'm going to deploy like 16 delta. This is above 15. Now sell it first. Put sell means add position. Next, see call delta. There are no 16 delta are available, and I'm going to sell 18 delta. It should be near. All right. So now here add position. Now let's check it here. Expiry date, have you seen? 39 days. It is more than 30 and less than 45 days. All right. Okay, now see here, this is the profit and loss graph. Now here first column is showing the probability of success, that is 81%. So we need more than 70 or 90. All right, 81% is more than 70. Okay. Next, it is showing 30,000 profit. All right, 30. If we success or price expire in between this range, we will earn 30,000, which is 26% profit in your capital. We need capital 1,16,000 to deploy this strategy. All right. Okay. Okay. Loss is showing undefined, means there are no limit. All right. Definitely we'll show you how to adjust the position step by step. Okay. Now break even, it is showing 148 and 233. Let me show you where is the break even. Okay, let me 148 somewhere here. All right, let me draw a horizontal line, all lines horizontal. 148, where is the 148? Somewhere there. Yeah, this one. Lower boundary and the upper boundary is 237. Let's see, 237. 237. Okay, this one, the upper boundary and lower boundary. Let me make it a little more bigger. Okay. All right, now you can see here, that is our range. All right, if till 25th November call India price expire in between this range, we will collect entire premium, that is 30,000 something, which is what is the return? 28%, I think 26% of our capital. All right, so that is the range. Sorry, that's the range. All right, now let's see here. All right, if price goes up, when to adjust our position? All right, trade adjustment or its management. Okay, now we deployed this strategy by using delta, which is one is 16%, 16 delta, and another is 18. All right, I think you remember. So first condition, when we need to adjust our position, first adjust the leg if delta increase by 15. So suppose market is somewhere here, if price goes up, now that is 16 delta, right? So it's increased by 15, what will be there? 31 delta, right? Call side delta. All right, and when call delta become 31, we need to adjust our position. And if remember, if we have expiry more than 50 days, then we will adjust our position. Otherwise, we will close and we will take the profit and we will come out from the market. That is the main condition. And the third condition, how we will adjust? Rule the untested side. What is the meaning of that? Untested side. Untested side means this is the call side, this is the call side, and this is the put side, right? Market is going upside, so we are going to adjust put side only. All right, we'll close our put position, we'll reopen somewhere there. This is the untested side, and if price goes up, it will be same. All right, so we are just focusing on delta. If call delta are increasing, we'll close our put side, we'll book our profit, whatever put side profit, and we'll reopen, we'll close the put and reopen by using delta. So I'll show you when to adjust. All right, or close the position if 70% credit received. So let's see, there are 30,000 profit. So if we collect 70% of 30,000, so we'll close our position and we come up from the market and we'll select another stock. All right, so let's see how we adjust our position and when to adjust.